I'm Steve Forbes, and you're watching Traders Nation.
Welcome back. You are tuned into Traders Nation. My pleasure to have back with us once again Anthony Saccaro. He's the president of Providence Financial. Anthony, welcome back to Traders Nation today. How are you?
I'm doing phenomenal, Kurt. Thank you for having me back.
Yeah, always a pleasure, Anthony. Hey, listen, so first quarter here, we saw some pretty big drops in the market, okay? Some are saying that these are buying dips. It'll recover, but will it?
Well, that's the question, right? You know, the challenge that the market is giving us today is it's not really acting on fundamentals, and yet when you look at the last few years, we've had actually four different occasions now in which the market has dropped over 10%.
Sure.
If we go back a little while, you remember we had the whole Brexit situation. That caused the market down, I think, 10 or 12%. Then we had the worst start in a January in history. I think that was 2016, if I'm not mistaken, and the market was down 12%. Prior to that, 2015, I believe, we had the currency debacle with China. The market was down, 10% when they adjusted their currency by 2%. And every time so far, the investors have been right. Yeah. It has been a buying opportunity. Yeah. It's bounced back, but that doesn't mean it will this time. And I hope it's not creating a false sense of security, but that's my fear.
Don't we fall into that pattern, though, of false sense of security? I mean, we see it pattern time after time after time again. And certainly that's the basis of the question, right? Because at some point, it's not going to bounce back. And then you got a little bit of a panic that sits in with some of these investors thinking, it's going to bounce, I'll buy the bounce, right? But sometimes it's a dead cat bounce.
At some point in time, if you keep stretching that rubber band over and over again, we know eventually it's going to break. And that's where we are with the market. And unfortunately, it's not the big boys that are going to get hurt. Yeah. All this volatility has really shown us that the big institutional investors at this point have one finger on the trigger. Sure. And it's the smaller investors right now that are in a very dangerous game of musical chairs. And when the music stops, it's not going to be the big boys without a chair. It's going to be moms and pops that want to retire in the next couple of years and they can't.
Yeah, so those guys come home from work. They worked all day long, 12 hours, hard day, come home, look at their stocks, and they say, hey, what happened here, right? So those are the ones that are going to be hurt, no doubt about that. So there's several key factors in an effort to gauge where the market's going to go from here. What would those be? What do we need to look out for if that rubber band does break?
So I think, volatility is what starts it, and we've already started the volatility. If you look at 2017, we had one of the best years. I think it was the third or fourth best year on record. Sure. 25% growth and smooth sailing, and we wish every year was like that. And then all of a sudden, bam, 2018 hits, and we have this choppy waters. Well, what changed? The answer is nothing. Nothing changed. Yeah. There's always been things that are going, that are happening. It was North Korea that caused the issue, and now it's these trade war possibilities. But, the fact is that the market is starting to be volatile, and volatility will precede the downward trend, and that's what's happening.
So do you think, so we named off a couple of the last four. Do you think this time around it is the talk of the trade wars between China and the United States? Certainly that's been a big buzz in the markets over the last month or so. And now the Chinese look like they're having a little concessions or appearance of concessions. Do you think that is what's going on in today's volatility?
Well, I think that is what is starting the potential downward trend. Yeah. We don't know whether we're down or whether we're up. Yeah. What we do know is from a macro standpoint, you go back to 2009 and the market's up over 350% from 2009 to now. We're in the second longest cyclical bull market in history, and the reality is we know that nothing goes up forever. So I think that the market is due for a major correction. Okay. I think this recovery over the last decade, Kurt, has been artificially driven by quantitative easing and artificial stock buyback and so on. And one of these events, whether it's to China or North Korea, who knows, but one of these events is going to be the trigger that starts that snowball going down the hill and rolls into an avalanche. So it may not be why the market is doing what it's doing, but something is going to trigger it.
Right. Bears are out there right now. They're saying there's a couple things. Federal Reserve is getting aggressive about raising rates. The stock market certainly is swooning. The yield curve, we talked about this last time, flattening out, Anthony. Are these clues that a recession is going to be coming?
Oh, yeah, absolutely. A flattened yield curve is not good for any economy. Yeah. When you've got when you've got 30-year treasuries just paying a little more than 10-year treasuries, and that's exactly what's happening.
Right.
So, and the fact is that, I think you nailed it on the head in talking about the Federal Reserve and the interest rates, because the interest rates are where the rubber meets the road. You and I and the government can talk all they want, and we can talk about how good the economy is, but where the rubber meets the road, the proof in the pudding, is with interest rates. And if the economy is doing so well, you should be able to raise interest rates. And if you can't raise interest rates, then it's a sign that there's a bigger symptom going on. And I'll tell you what that symptom is. It has to do with baby boomers getting older. That is the underlying symptom of where we're going to go in the future.
So what's going on with the baby boomers? They're getting older. Let's face it, they've got a lot of wealth, and they're not going to want to spend it, are they?
That's the key. That's the key. You go back to the best generation that this country has ever seen, and that was in the 80s and 90s. Okay. Well, the baby boomers were in their 30s and 40s and 50s, and now the baby boomers are 50 to 70 years old. There's 10,000 baby boomers a day on Social Security starting to collect Social Security. And when you get into older ages, you don't spend more. You spend less. You curtail your spending.
Sure.
So all of a sudden, you've got this massive wealth that's not going anywhere. No wonder GDP is only in the 2% growth range, or not even.
Right.
That's exactly why. And as they get older, they're going to get more. They're going to get more thrifty. They're not going to get lesser. They're not going to get more frivolous with their finances. Now, the saving grace on the back end could be the millennials, but it's going to take another decade or 20 years for them to catch up.
At least. So that's a big time gap, and that's a big spend gap. I think we're going to run into some problems because the baby boomers is a huge, huge market. They're not spending money. We got to find that money somewhere else. We got to retail it somewhere else, Anthony. Your thoughts?
100%. That's exactly right. That's the problem. And I don't think we're in a low interest rate environment. I think we're in a new interest rate environment, at least for another 10, 20 years.
Okay, so let's talk about interest rates. Feds are looking to possibly, we don't know this for sure until they actually do it, the next 3 quarters possibly revising that interest rate up. Like you said, are they going to be able to jack it up maybe a quarter point, what have you? Your thoughts looking forward with the Feds and raising interest rates?
Well, I think with the volatility that we have today, if the Feds do continue to raise rates, then it's going to cause the market to stumble. And we're at the point where the market just is a little snowball right now starting to go. And at some point, it's going to keep going just like it did back in 2008, just like it did back in 2001. And it's going to keep going, and no one's going to be able to stop it no matter what you do. And that's why in 2007 and 8, when the market was crashing, the Feds lowered the rates from 6% down to 0. It didn't work. They had to start printing money, and it was like, let's take everything off, all hands on deck. Right. And the reality is something's going to start that snowball, and then you won't be able to stop it. And interest rates are something that very well could be the start of that avalanche.
All right, so the takeaway here is instead of fixating on GDP, because I want to go back to where we start and we'll end here, it's better to look at the assortment of indicators to judge the health of the economy. Would you agree with that?
Oh, 100%. And yet here's the problem, Kurt, and that is a lot of the indicators that they're pointing to, I think, are very misleading. Unemployment, they point to the fact that unemployment's under 4%, but unemployment doesn't include people that are no longer getting an unemployment check. So they still don't have a job. They've exhausted their unemployment, but they're not counted as unemployed anymore. It doesn't include the millennials that can't get jobs, just got out of college, can't get jobs. It doesn't include those people. It doesn't include the 50-year-olds that want to work, but they can't work. So bottom line, that's an extremely misleading number. Inflation, another misleading number. The reality is the CPI is reporting inflation at under 2%, but it doesn't include things like energy and
like
gas.
Big items that we use every single day. Anthony, where can we find you? It almost seems skewed. We're out of time, but I'd love to talk about inflation and how they report that on another edition. Anthony, where can we find you at?
Our website, if anyone has any questions, ProvidenceFinancialInc.com.
Head on over there today. Anthony, thanks for being with us today on Traders Nation. Appreciate it.
Kurt, thank you for having me.
Have a great day. We'll be right back.